Everyone tells you the same thing about investing. Just invest for the long term. Zoom out. Time in the market beats timing the market. It sounds responsible, it sounds mature, it sounds like the kind of advice someone with a leather chair and a CNBC microphone would give you. But here's the problem. Long-term investing has quietly become the most abused, misunderstood, and financially dangerous myth in modern markets. Not because it's always wrong, but because people use it as a substitute for thinking. And by the end of this video, you'll understand why simply holding forever doesn't guarantee wealth, doesn't protect you from risk, and in many cases, quietly destroys returns while making investors feel smart the entire time. Let's start with where this myth comes from. Long-term investing didn't become popular because it was philosophical. It became popular because it worked once. After World War II, the United States entered one of the most extraordinary economic periods in human history. Factories exploded with production. The middle class expanded rapidly. Debt was low, population growth was strong, and productivity kept rising. From 1945 to 1980, the stock market rewarded patience almost automatically. If you bought broad indexes and held them, time really did solve most problems. So Wall Street took a historical accident and turned it into universal advice. Here's the first uncomfortable truth nobody tells you. Long-term investing only works when the starting price makes sense. And price is the one thing nobody wants to talk about. You can be right about a company, you can be right about innovation, you can be right about growth, and still lose money or waste decades if you overpay. Markets don't reward belief, they reward math. Let's rewind to a moment Wall Street doesn't like to remember, the early 1970s. At the time, investors believed they had discovered a cheat code. They called them one-decision stocks, companies so dominant, so powerful, so inevitable, that you only had to make one decision: buy and never sell. Sound familiar? These companies were household names. They dominated their industries. They printed cash, and investors believed they were immune to failure. So people bought them and held them for the long term. Then reality showed up. From 1972 to 1974, the market collapsed. Inflation exploded, growth slowed, and those can't-lose stocks lost 60, 70, sometimes 90% of their value. And here's the part nobody tells you. Many of those stocks didn't recover for over a decade. Some never did. Investors who did everything right, who held, who stayed patient, who ignored the noise, spent years trapped, watching inflation eat away their purchasing power while being told to just wait longer. This brings us to the core lie of long-term investing. Time does not heal bad prices. It only hides them. Holding something longer does not magically improve returns. It simply delays the moment you're forced to admit the math doesn't work. Now let's talk about the phrase everyone loves to repeat. Time in the market beats timing the market. It sounds wise. It sounds safe. It sounds like something you put on a coffee mug. But here's what that phrase quietly ignores. Valuation is not timing. Valuation is math. There's a massive difference between predicting short-term market moves and refusing to overpay. And yet, modern investing culture treats anyone who mentions valuation like a conspiracy theorist yelling about market crashes from a basement. Let's look at a brutal historical example. In the year 2000, during the dot-com bubble, the S&P 500 traded at extreme valuations. Tech companies had no profits. Some had no revenue, and investors were told it didn't matter because it was the future. Now here's the part that hurts. If you invested in the S&P 500 at the peak of that bubble and held patiently, it took 13 years just to break even in real terms after inflation. 13 years. No crash trading, no panic selling, just quiet, slow, opportunity-destroying stagnation. That's not compounding. That's financial purgatory. And yet people still say long-term investing is safe. Safe from what? Safe from volatility? No. Safe from inflation? Definitely not. Safe from opportunity cost? Absolutely not. Because while your money is patiently recovering, other assets, other opportunities, and other markets are moving on without you. This leads us to the second myth nobody talks about. Long-term investing assumes the future will look like the past, but history doesn't repeat. It rhymes, and sometimes it screams. The post-war boom was fueled by demographics, cheap energy, and expanding globalization. Today, we face aging populations, rising debt, deglobalization, and slower productivity growth. Yet investors are told to expect the same returns forever. That's not optimism, that's denial. Now let's talk about index funds, the sacred cow of modern investing. Index funds are sold as the ultimate long-term solution. Diversified, low cost, safe. And here's the part nobody likes admitting. Index funds don't eliminate risk, they concentrate it silently. When markets become top-heavy, index investors are no longer diversified. They're making a massive bet on a handful of companies at extreme prices. They're told they're being responsible while unknowingly riding the same concentration risks that destroyed investors in previous bubbles. Here's the psychological trick at work. Long-term investing removes responsibility. If something goes wrong, you're not wrong. You're just early. If returns are bad, it's not the strategy. It's the timeline. If losses mount, the solution is always the same. Wait longer. At some point, long-term stops being a strategy and becomes a coping mechanism. Now let's talk about the most dangerous part of this myth. Long-term investing rewards inactivity, not intelligence. It trains investors to believe that thinking is optional, that analysis is unnecessary, that valuation is noise, and that's incredibly convenient for institutions. Because passive investors don't question fees. They don't question concentration. They don't question systemic risk. They just keep buying. And here's the irony. The same institutions telling you to invest for the long term, rebalance constantly, manage risk aggressively, and never ignore price. Long-term investing is preached to individuals, while professionals quietly do the opposite. So what's the truth nobody talks about? The truth is this: long-term investing is not a guarantee. It's a conditional strategy. It works when prices are reasonable, growth supports expectations, and time actually compounds value instead of correcting excess. When those conditions don't exist, time doesn't help you, it traps you. This doesn't mean you should trade constantly. It doesn't mean you should panic sell, and it definitely doesn't mean markets are rigged beyond participation. It means blind patience is not wisdom, it's abdication. The real lesson of long-term investing isn't hold forever, it's think longer than everyone else. Think about price, think about cycles, think about what assumptions are baked into today's valuations. Because the market doesn't care how patient you are, it only cares whether the numbers make sense. And this is why the myth survives. Because it's comforting, it removes accountability, and it allows people to feel disciplined without being analytical. But comfort has never created wealth, and patience without thought has never protected capital. So the next time someone tells you to just invest for the long term, ask the question nobody asks. At what price? Because time doesn't fix mistakes. It just gives them room to compound in either direction, and the market will decide which one you picked. Financial myths, where comfortable lies meet uncomfortable math.